Okay, good morning, everyone, and welcome to PIER Economic Seminar today. My name is Jetawat, and I will be acting as a moderator for today's presentation. It's our pleasure to welcome Professor Utpal Bhattacharya, as Chair Professor of Finance at Hong Kong University of Science and Technology. His research focuses on financial markets, including stock trading and market integrity. And today, Professor Utpal will be presenting his paper, Deposit Insurance, Believers and Doubters. Okay. If everyone have question, the Q&A session will be held at the end of the presentation. Thank you.
Hello. Good morning, everyone. It gives me great pleasure to be in Bangkok, Thailand. This is one of my most favorite countries, and this is the fourth time I am visiting, and this is the first time for a professional visit. And I like it so much that I'm trying to come here again in summer, and if Canis can pull it off, then I will be able to teach a course for 2 to 3 weeks in a school for PhD students or assistant professors. Okay, so a little bit about myself. My name is Utpal Bhattacharya, and that was very good pronunciation. And the reason Thai people can pronounce my name very well because it's all Sanskrit. So Utpal in Sanskrit means a lotus. We have 16 words for lotus, and this is a special lotus on which the Buddha sits. There are other words for lotus in Sanskrit like Kamal and Pankaj. Pankaj is the lotus on the mud, but Utpal is the lotus on which the Buddha sits. My last name is Bhattacharya, which can be split up into two parts, Bhatt and Acharya. Acharya means teacher in Sanskrit, and Bhatt is a person who got a PhD 500 years ago. So my ancestors have been teachers for a long time. Actually, that's not true. My ancestors have been very poor Hindu priests for a very long time. What may perhaps be a little interesting about me is that I teach in a new country every summer. So last summer I was teaching in Kazakhstan. I've never been to Thailand. So pressure, Canis. I'd like to come here. Okay. So let's start this paper. And I notice a lot of young people, some PhD students or some people who have passed PhD, graduated their PhD, and some who are doing their PhD or some intending to do a PhD. So actually I had a marketing slide selling a HKUST PhD program. But unfortunately, because of security reasons, I can't show that. But all I want to tell you is that Hong Kong and Singapore have the best PhD programs in Asia. And HKUST, I think, I'm not boasting, here's the best in Hong Kong, at least I know that. And you guys are just interested in money. So we offer $30,000 a year. Everything's free if you get accepted. It's a little difficult to get accepted. But you have an advantage because we guys are now focusing in Southeast Asia. Most of our PhD students are from mainland China, and we don't want any more mainland Chinese people because everything's dominated and we can't place them anywhere. So that's, and it's not, I have anything against mainland China, but we need a little bit of diversity. So if any of you are interested and are very good, do apply to us. And that was what the marketing slides were. The reason I said we are the best PhD program is because we are the only place in Asia which places our students outside Asia. So our students have become assistant professors in Imperial College, London Business School. My first student, Indian guy, just got tenure at Georgia Tech. Then another student, not my student, just got tenure at University of Florida at Gainesville. So we place our students very well, but they are not. Unfortunately, they are not from mainland China because, because of geopolitics, it's easier for Thai students to get jobs. So that's why I really want you guys to apply. Okay, let's start the actual paper. I don't do papers like this, and I advise you not to do papers like this. because it goes against my entire philosophy. So I'm a very conservative guy. The research philosophy is you have a theory, because we're trained as a theorist. You work out your model, you get testable implications, and you test your implications. That's how science progresses. You test some implications from theory. That's what normally science progresses that way. You don't do things like you take your telescope to the sky and you're just data dredging, data mining, and then you discover there is a purple planet out there. What the hell? Someone has to explain that. This is one of those rare cases where theory follows empirical finding. So this paper is actually this latter thing. We were trying to test some theories on behavioral finance, and by chance we discovered something very interesting and something we did not expect. Now, being a theorist, I want to explain that. And I'll be very honest with you, this paper still doesn't get it. We don't know how to explain that very well. We are trying. So it's very, very work in process. So I really respect your questions at the very end to help me improve the paper. And Canis, that'll be a chance to chew me, but not now. Okay. So this is called Deposit Insurance, Believers and Doubters. And it's with 3 of my German colleagues. One of them was my student. They are both, all of them basically have connections with the University of Frankfurt, but they are in different places now. So University of Frankfurt, one of my first summer teaching jobs was in 1996. We sort of started the behavioral finance group there. And most of them have become much better than I am now. So these are trained students from there. So we were in that behavioral finance, we do household finance and all sorts of stupid things that investors do. And we were doing that. Then we discovered something else. So our research question has changed. So if Canis gives me a chance to teach, all research starts with a research question. And that's why it's very difficult to do a good PhD dissertation. Because I was trained in India, and like most Asians, we are trained to answer questions, and some of us are very good at doing that. But then you start doing research where the question is not you don't need to solve a question. You actually have to create a question. It's a different mindset. And that's what we are not very good at doing. It took me a long time to figure this out. So a research question is what an editor of a journal will first look at. And I say that because I was the editor for 6 years in a B-grade journal called Financial Management. So we say, what is this research question? What is this guy trying to answer? So what am I trying to answer and my co-authors are trying to answer? We say, if you look at any investment textbook, they tell you that there are different types of assets. There are risky assets. And of course, for the last 150 years, we've been trying to find out what is the definition of risk. And if there's risk, they'll expect a higher return because they're risk averse. But there's another special asset, which they call riskless asset. And riskless assets are assets which don't have any risk by definition. But these guys also offer a return, not as a compensation for risk, because they have no risk, but as a compensation for your patience. So that riskless return is the risk-free rate, which all these finance textbooks put in the y-axis. It's an anchor, the risk-free rate. Now that's in the textbooks and the minds of a theorist. What exactly is a risk-free thing in the world? So when we teach our students, we say, well, what we do in practice, we take the US 1-month Treasury bill as a risk-free rate or the 3-month Treasury bill as a risk-free rate. Why? Because the United States government has not defaulted as yet. And there's that inflation risk, but short term, other than that, it's the nearest thing we have to a risk-free rate. But if we do have a risk-free rate, we have an interesting conceptual insight. They should offer the same risk-free interest rate to all investors in a frictionless world. Because one of the fundamental assumptions are humans are greedy, there's arbitrage, so it should offer the same interest rate. If someone offers a more interest rate, everyone will go there because it's risk-free. To empirically study a world, we don't have such a world. So where almost riskless assets are offered to investors. So what are almost riskless assets? So when I was growing up, my dad, who was very risk averse, put up nearly all his money in banks because he believed in banks and the bank deposit, because banks in India, if they go bankrupt, they're insured by the government. So basically, you can get your money back. So the only risk you probably would be an inflation risk, but at least those days in India, inflation was not volatile. So there's almost riskless asset, bank deposit. And I've been so impressed with him, affected by him. Even today, as a chaired professor in finance, most of my money is in bank deposits. So what's the perception of risk if you put in a bank deposit? It's a doubts about the deposit insurance that guarantees the bank deposit. So the deposit insurance, you have full faith in the deposit insurance, they will cover everything. It is riskless. And if you're putting your money in a bank in Thailand and you don't quite believe in the deposit insurance offered by this august institution, it's not that riskless. So a research question is, so when I started this project, I said, okay, let's look at Hong Kong, which is a very stable banking system. Let's look at the bank deposits guaranteed by the Hong Kong FMA. Let's look at the 3-month rate. What's the deposit interest rate that's offered by Hang Seng Bank, Bank of China, HSBC? And they were a little different from each other. So why are they a little different? Because they're all riskless, right? Well, there are other features, right? Sometimes, for example, you like HSBC because the teller, you want to talk to a human being and that human being is very nice. There's a shoe leather cost, changing from one bank to another has a lot of transaction costs. Or HSBC offers other features that are linked to this. So there are all these frictions, and that's the reason we have differential interest rates. So let's look at a situation where these frictions are as less as possible. So if there are few search or other transaction costs or financial literacy concerns, some of us are so financially illiterate that we don't even understand what fixed deposit is, though not in this paper, that impedes switching. Do we see a group of investors who believe in the guarantee provided by the deposit insurance and thus always invest in term deposits that offer the highest return? So these are the people we call the believers. And another group of investors who never do. They don't go for the highest interest rate. And these are the people who we call the doubters. So let's put a little more context in this. Now I'm focusing on deposit insurance because, as I will explain, if Candice gets me a job here in summer here, a paper just focuses on one simple idea. You don't want to confuse the paper right up front. So you have to be very honest about your assumptions. So our focus is on the country's deposit insurance scheme, but that's linked to a larger macro situation, right? The belief in a country's deposit insurance scheme is related to broader notions of trust in banks, institutions, or macroeconomic conditions in the country. For example, think about what's happening in Thailand these days. Your belief in a deposit insurance scheme offered by a bank is affected by what's happening in the Thai political situation, the economic situation, what Trump is doing, all the tariffs and all that stuff. So it is affected. So what we do is we say, as we applied econometrician would say, let's think of this as a summary statistic of all of that underlying causal variables. So this paper, because of lack of data, cannot isolate the source of these beliefs. We therefore assume, so that's an assumption, The belief in a country's deposit insurance is a summary statistics of these more macro beliefs. Okay. Now you may say, that's a strong assumption. It is a strong assumption. You should note it, however, we document that these beliefs are polarized. Even if it's come from something macro, why do we see a polarization in these beliefs? Okay. So now let's give you the exact context. So as I was saying, I've been working with them for the last 29 years. So they have lots of great data. So this is customer data from the largest fintech company in Europe, which I'm sure you guys can figure it out as soon as you Google it, but I can't reveal it to you. And we look at only German investors because most of their clients are Germans, and we don't want to cloud our research with home biases. There's another thing which I noticed, because we have calling 14 people to campus for campus visits, PhD students. Always focus on just one idea. The moment you tell people that you have more results, reveals to the listener or to the editor or the referee that you're not very confident about your main result. So just try to do one thing very well instead of too many things badly. So home bias is actually very interesting. That's how we actually started this paper. But we said, forget that. Just focus on German investors and get rid of that home bias thing at the moment. That could be another paper. So a large European fintech company that offers guaranteed term deposits to its customers in 2004 to 2018 period. So how does this work? This is a fintech platform. On one side, our suppliers are bank deposits. These are banks in the European system, which tells this partner bank, today we are offering a 3-year term deposit. Today we are offering a 1-year term deposits, and these are interest rates. They're all in euro. They have to be in euro. So there's no currency exchange rate risk. And all these banks that are offered are in the European system, which offers, not all countries allowed. These are countries which have signed on to that ECB system, where their country's deposit interest rate guarantees these banks. Now, let me be very clear. ECB does not guarantee these banks. The country's deposit insurance scheme guarantees this bank. But as history has shown us, as we saw in Greece or in Iceland, somehow there's a belief that the EC may step in. It's like an ultimate backstop. But let me be very careful. It's not contractual. There may be belief. So these guys are offering them to the partner bank. And the partner bank every day lists all these things from descending order of interest rates. This is the bank which is offering the highest interest rate. This is the bank which is offering the lowest interest rate. These are all in Europe's. And if you click on the bank, you will see a lot of details about the bank, its ratings and things like that. And if you click at the country, you will get a lot of data about the country on its sovereign credit ratings and things like that. On the other side, customers, and as I said, most of them are Germans, they are trying to invest in high interest rate products. Why? Because in the 2014-2018 period, interest rates in Germany were almost zero, bank interest rates. So they're going for yield. And something which some of them consider riskless. So then these guys are told, your total investments cannot be more than 100,000 euros in a particular bank, because that's the guarantee that these ECB has. So they're not allowed to invest. They are also told that in our history, there's never been a default in any of these banks. That's true. And then they are promised that if there is a default, this platform will help them get their money back. That's a promise. It's not a contractual agreement. So that's it. So every day, if you're a customer, you get to see these things. So how do you become a customer? You put money in this platform. It's like opening up a checking account. And from that money, you can transfer money to any of these banks. They're all private bank. There are all types of banks. So she broke the rule, but since she's Panti, so it's okay. And you can also chew me if you want. These are very good question. So these are banks which generally don't have branches in Germany. They are relatively unknown banks, but they are trying to raise money, and the only way that they can raise money is offering high interest rates. So they are not well-known banks. Yeah. The credibility is towards the low end. Yeah. The bank's credibility is the low end, but the banks are all been promised deposit insurance from the country's central bank. That's true. Okay, so bank savings are protected. Since the EU-wide harmony deposit was introduced, savers have not suffered any losses. In case a credit event would occur, the fintech company promises to support customers. There are some other frictions, though, which I want to be very honest about. You can withdraw prematurely, but there's a huge penalty for that. And in our data set, no one's withdrawn prematurely. But that doesn't mean the ex ante, that thing doesn't exist. Okay. Now, as I was saying, friction. There's zero search cost for interest rate shopping. There's no shoe leather cost. You don't have to go from HSBC to Bank of China or something like that. You don't even have to click it. It's all in there. You can just transfer money from one to the other. All customers see all offerings in the fintech's company publicly online platform on the day. A click would rank by descending order of interest rates. You can also rank by ascending order of interest rates. Other clicks would give country, currency, and bank information. Well, currency, I shouldn't have put there because everything is in euro. Few constraints. You have to be a European customer and can invest subject to opening an account in the fintech company and providing some relevant customer details. Money from this account can be transferred to partner bank anytime. So you have to open an account and then you can transfer to any of these things. There's some other issues there which we have to look at, which is taxation. But since we are looking at all German investors, so that's not an issue because if there is taxation, but everyone has the same taxation. So our empirical question, remember I said I'm taking a telescope and trying to find out how do customers invest? Okay. So let's do some descriptive statistics. If everything was riskless, there would be just one interest rate, right? That's not true. So the difference between countries, so this is for the 6-month deposit, 12-month deposit, 24-month deposit, 36-month deposit. So those are different colors. And the spread, which is the max minus the min, and various days in our 4-year period, ranges from 100 basis points to as high as 175 basis points. That's a huge spread. That immediately tells me that some of them don't consider this to be riskless. There's also a time series variation. Now you may say, Professor Bhattacharya, you're exaggerating the results of your paper. You're doing max minus min. Okay, fair question. Let's do max minus second max. Still there's a spread. So number 1 and number 2. So at every point in time, you look at the day and say, this is the highest, this is the second highest for various deposits. And so there's a spread. So we rule out, so this is not riskless. At least some of them don't think it's riskless. Which is interesting to me because the period was a low interest rate period and term deposits were near zero. So why is it that they're not if they're going for yield, why aren't they going for the highest yield? And if everyone's going for the highest yield, the other interest rates won't survive in the arbitrage. So that's a puzzle. So that's now we think, what is going on? Now coming back to Pentis's question, even within a country, there's a dispersion. So we have done it for various countries, Austria, France, Portugal, and Bulgaria, Italy, Sweden. And you can do it for many maturities. Here's for the 1-year maturity. which tells me that these German customers say when they look at Bulgaria, they differentiate between a good bank in Bulgaria and a not so good bank in Bulgaria, though the Bulgarian central bank offers deposit insurance. So even within a country, there is dispersion. Okay. So there would be no paper, and I won't be invited by him here if he didn't find this. So this is that purple planet. What do we find? We find that there is a bimodal distribution. So this is a 4-year period. You made a choice. Did you go for the highest? Second time you make the choice, did you go for the highest? Third time you made a choice, did you go for the highest? So guys who go for the highest every time are here. And guys who never go for the highest are here, 0. So everything is scaled between 0 and 1. So what do we find? Of course, this is an imbalanced sample. Investors come and go. 67% of investors never, ever choose the highest interest rate. But 11% of investors always choose the highest interest rate. Okay. This is a bimodal distribution. So for those of you who do politics or who have been thinking of what's going on in the world today, the word polarization statistically means a bimodal distribution. This side, that side. There's nothing in between. So this is the nearest thing of a bimodal distribution of beliefs, or not beliefs, or behavior. Okay, that looks interesting, right? Now, this is why you should need to do a PhD. This is actually deceptive. Because if you toss a dice, the probability of getting number 6 is 1/6. The probability of getting not number 6 is 5/6. If you toss it many times, you will get a bimodal distribution randomly. So you need a benchmark. So if this was a random guy, what would he have done? This is what it looks like. Now, why isn't this smooth? Because remember, this is not a simple tossing of a coin. Things come and go, and it's a lot more complications. So we have to do a bootstrap. So this is if this was a random guy. So we know in finance that you have to calculate that. You have to compare the actual with the random benchmark. So let's do that. So this is the random benchmark. Now compare the actual with the random benchmark. And this is the first punchline of a paper, which is the proportion of people who never go for the highest interest rate is higher than the random guy. The proportion of people who always go for the highest interest rate is also higher than the random guy. So again, for the PhD students, we live in a world where too many people are writing a lot of papers. Most of them are bad papers. But more important is that you have to attract attention, right? So no one reads your paper these days. So that's why if he offers me a job, I'll tell you how important it is to have a cute title and a good abstract, because no one reads anything other than that. And in your introduction, if you can, if the results of your paper are in a graph, you have a good chance of getting published, especially if the results are interesting. Now, not all papers can do that. We are very, very lucky that in our paper, we can actually do that. This is the graph. This is the main result of the paper. We thought it was main result, but I think there's something more interesting. So this is it. I can go now. You will give me lunch, right? Okay. Actually, the main result is this. So across countries, we see a polarization. But if within a country, we don't see a polarization. Which is that if you just look at Bulgaria, which is in our view is the worst in terms of all ratings in our list. If a person invests in Bulgaria, she always goes for the highest interest rate. So there's no demand polarization within a country. There's demand polarization across countries. So this is coming back to your question. It has something to do with deposit insurance across countries, because within a country it doesn't quite matter because they're all going for the highest interest rate. Okay. For those of you who are theoretically minded, remember I was trained as a theorist and then realized I can't publish theory papers anymore. So I started doing empirical papers with my PhD students. So this is an equilibrium explanation. Remember, finance is economics, though we pretend it's not. So we have a supply side and a demand side. So this is a classic textbook equilibrium from a segmented market. So what's a segmented market? This is the price of funds, which is interest rate. And there is an x-axis. We have done something unusual. It's a non-monetary preference. So there are some banks, like in France or in the United Kingdom, where the Germans have much more faith in. So let's call it more preferred banks. And there are banks in countries like Bulgaria, which are less preferred. And this is the average. So this is a simple model, not very complicated. This is the supply curve. And if you want to get more funding, what do? You raise your interest rate offered. If you raise your interest rate offered, you'll get more funding. This is only from the people who are the believers, because that's the only thing they care about, interest rates. So that's why it's this flat line. But the doubters like interest rates. So if you increase interest rates, they will give you more money too. But if you're from Bulgaria, you have to raise interest rates a lot to get the same money. Here, not that much. So those are the indifference curves of the doubters. So we start with the fundamentals, which is indifference curves. And then we say, given those preferences, it seems to us that if, and this is assumption, all banks want Q, then all of them realize that the supply curve looks upward sloping, which means if you offer a higher interest rate, people are going to give you more Q. So this is for the blue guy. But for the doubters, the slopes are different, because we saw there are two different things depending on whether they're preferred banks or more preferred banks. Where supply equals demand is equilibrium. So we have three potential equilibrium points. But banks would, of course, want to offer as low interest rates as possible. So C is not in equilibrium, though it potentially was. So the only things that remain are A and B. So if you don't follow the theory, in simple English, the answer is believers choose term deposits with the highest interest rates offered by the less. Because believers believe in deposit insurance, they always go for the highest interest rate. And the highest interest rate is being offered by banks in Bulgaria. But the doubters choose term deposits with lower interest rates, and they go for interest rates offered from banks in France. They're offering low interest rates. Why? Because they don't trust the Bulgarian banks. They trust the French banks more. So there's a trade-off. So basically, believers, the riskier countries, high interest rate. Doubters, the less risky countries, lower interest rates. That's the equilibrium. Now, I'm not a banking guy, so I'm starting to read this literature. I realize I will never be able to finish it before I die. It's a huge literature, right? So there is a lot of work about dispersion equilibriums and equilibrium, and we do not claim this is the only reason. And there are other things that may happen in those 4 years, insurance-related concern, difference in monetary policy passed through other country-specific factors. And we cannot isolate the source of these dispersions, though in a serious top 3 journal, I can't get away with this. They will ask me to do this. But at the moment, let me go back to my usual excuse. Whatever the source, we still document that the choices are still polarized. Okay. So that's the punchline of the paper. There is polarization, intense polarization within countries, but not within a country. Now let's go, PhD students. Once you've given your punchline, you're going to get more results. But don't do results which are not related to that. So now let's look at related things. What are the determinants of offered interest rates? So if your country rating is high, you offer a lower interest rate. Of course, France offers lower interest rate than Bulgaria. If your bank rating is high, measured by these bank ratings, which is ABC or bank tier 1 ratios, as expected, your bank offers a lower interest rate. And you control for a lot of fixed effects and all of this stuff. You notice that within a country, there's still a big difference of offered interest rates between the max and the min, about 100 basis points, which is what our graph was showing as well. Okay. So remember what I showed you, which is polarization from the demand side. Now, why did I need a model? Because the model is also telling me that there's a polarization from the supply side too. Do we see that? So this is a simple test. Remember, I really like simple tests, but you PhD students become more sophisticated. So simple test is, I'm a bank. I offer the highest interest rate today. 6 months from now, do I still offer the highest interest rate? 6 months from now, do I still offer the high interest rate? So if I do, then the correlation should be 1. If I offer the lowest interest rate and I keep on doing that, the correlation should be 1. So you look at these correlations between T and T plus 6 months for various banks, and this is across countries. What we notice that the correlations are the highest in the diagonal, which means that there is persistence. So Bulgarian banks do not become French banks the next day. There's persistence across time. Now, since these are my German co-authors, they insist on behavioral work. So we said, okay, let's look at the former regression we had and look at the residuals from the equation. So in that former regression, we used control variables that are all observables, like the bank credit risk and all these things, all risk-rated things. Let's look at the residuals. We noticed that there is persistence within our residuals as well, which is interesting, which is telling me that a German investor may like France for reasons which are behavioral, just like French people. May not have anything to do with risk. Could be, I don't know. Okay, now this is the thing that I think will ultimately sell the paper, because with one of the silver lining of Donald Trump being my president is political finance is becoming very hot. What we notice is that these believers and doubters also come from different parts of Germany. So an average investor faces a choice at 22. As I said, 11% always go for the highest, 67% never do. But who are these guys? So if you're going for the highest, you're younger. You live in the former West Germany. You have more trust in the European Central Bank as measured by surveys. Longer maturity term deposits because you have more money on the table. It's rational. And less number of products in the choice set, attention deficit. And investors who make more decisions. So these guys are rational. So basically, if you switch this around, the people who are not going for the highest are older people who live in the former East Germany, which was a communist country, and European and people who have very little faith in the European Central Bank. Now, why is this interesting? Because those of you who are following politics are probably obsessed with the United States, but the same MAGA phenomenon is happening all over Europe. So there is the right-wing surge in the United Kingdom, in France, in Germany, just about everywhere. And there is this common thread in these populist things that they don't quite believe in these elite institutions. Okay, let's go back to the rational model. So let's look at a multi-choice regression. So we span the entire choice set at the point of decision making. We do not only look at the actual choice, but walk down the roads not taken. What do we find? We find, as we would expect, interest rates are very important. 1% differential in the interest rate makes it about 10% more likely the product is going to be chosen. The investors do reach for yield. Across countries, deposits from higher rated countries, on average, they offer lower interest rates, are more likely to be chosen. But this is where it becomes interesting. The results are very different for these doubters and the believers. We find that the interest rate is extremely important for the believers. But we throw out the believers from a sample, interest rates don't matter. And within a country, it seems since everyone is going for the highest interest rate, none of this matters at all. Bank supply, now if you're a bank, so you can always borrow from other literatures. You can borrow from the mutual fund literature, the hedge fund literature, and look at the flow regression. So you look at the flow regression. Again, interest rates are very often important. It's by far the most relevant decision variable to track flows. Offering the highest interest rate product has a huge impact on the ratio of investors to investor terminal. It increases the ratio by 20%. That's offering the highest. Just offering your offered interest, increasing your offered interest rate at 1% increases the ratio by 18%. Again, if you throw out believers, you do this thing on just doubters, offering the highest interest rate has no effect. So this last piece of evidence supports market segmentation, which is what the testable implication of theory was. Believers choose term deposits with the highest interest rates, and that's why interest rates matter a lot to them. Depositors choose term deposits with lower interest rates offered by the more preferred banks. It's not that interest rates don't matter to them, it matters much less. And this is something which we are trying to get an interpretation for that. We don't have a good interpretation. What is this result? That you start off with a believer, and then you look at your successive decisions, you become less and less a believer. You start off as a doubter, you become a little believer, but not much. So what is this telling me? We find more persistence amongst doubters than amongst believers. Now, we don't know how to interpret that. Within a country, again, very different. Everyone becomes a believer at the end, and they all start going for highest interest rates. Okay, so whenever we present this paper, people say, oh, it's about diversification. You invested in France, then you invest in the UK, the classical theory, right? So that's why you're not going for this thing. Well, the thing about problem with the division, believers believe that asset is riskless. For them, there's no reason to diversify. Doubters, there is a reason to diversify. So there's a reason to diversify. It's a good story. But if it's an alternate story, why are they diversifying across countries? But within a country, they are not diversifying. They're all going for the highest interest rate. So something more nuanced is going on, which at the moment, I'll be very honest with you, we don't understand quite well. So work in process. Our conclusion is using customer data from a large European fintech company. Again, remember, why are we doing this? Because we started from the textbook thing. What is a riskless asset? This is the nearest thing we have for a riskless asset. Everyone should go for the highest interest rate. There should just be one interest rate, but there isn't. We document considerable heterogeneity. for such a simple and virtually riskless product. And this is the purple planet. 11% of investors always go for the highest yield, and 67% never do. Well, theoretical model is nothing, it's not a contribution. It's like a textbook model of market segmentation. And that explains this, which is there are two types of people. Believers who think they are riskless, they're always going for the highest interest rate. Doubters who don't think they're riskless, different countries have different risks. So they are not going for the highest interest rate. So data support this implication. It may support other implications, but certainly not the diversification story. Okay. So this is now very important for the top level journals. Does your paper have a larger story? So here are some parting thoughts. Social and political polarization is a defining feature of our age. It consists of the splitting of a group into two distinct subgroups that are at different ends of a spectrum. Religious, non-religious, right, left, black, white, yellow, Muslim, Hindu, Christian, income divides, rich, poor, urban, rural divides, highly educated, lowly educated, and so on. Very interesting. And I think this is happening in the world. Or it was always there and we have more data now. What this paper shows that we have a similar bimodal distribution and a propensity to invest in virtually riskless securities. We see a group of investors who always invested, which we call the believers, and then there's another group we call the doubters who are distrustful. So what is the larger question? It seems that the trust in institutions is also polarized. Now, why I think is a very relevant paper, because it's my fourth central bank presentation. Central banks are apparently very interested in this, is because of the trust, because most central banks are fixated with inflation, right, as they should be. And there are these political tensions, as we see in all over the world, including in Thailand with the government, right? The government wants low interest rates. Central bank governors say, no, inflation is more important. That's an old debate, because all the models in central banks assume a representative agent. What we are claiming is that heterogeneity exists, and that's very important. What happens if some people believe in you and some don't believe in you? How should policy be changed? Those are the larger questions. Thank you. Okay, now to get chewed up.
Okay. Thank you, Professor, for your excellent presentation. And we still have time for questions. Yeah.
So I have two quick comments. One is about diversification. So it's natural that people would diversify across countries, but like within country, they might perceive banks, so the source of difference is from the depositing institution within those countries. So it's natural that they would go for highest, right? Okay. Okay. Second one is for more clarification. So your definition of doubters is people who never invest in highest interest rate options, right? So one, I think you mentioned that. So it's quite perplexing to me that you have like a time trends of how people change. So like the first investment there, you know what I mean. So I thought that the definition of doubters or non-believers is like static across within each individual. So maybe you can
yeah, so that's a very good question. So let me answer your first question. The reason we define doubters that way, it's a very simple way of defining doubters. It's a way to sell your paper. Never do that, right? So because some people ask me, suppose they don't go for the highest, but what happens if they go for the second highest? That weakens the marketing of the paper. But your second question is, those graphs are a little deceptive because people come and go. So there's one guy who makes one decision, there's some guys who make two decisions, and they disappear from the sample set. So those are for the whole of the thing. We have to be very careful when we do those graphs, and now we are. So we look at people, for example, the same type of people, like in the earlier days of this fintech, you had only 3 or 4 products being offered. Now there are 40 products being offered. So when you have 3 or 4 products being offered, right, you tend to go for the highest. So now if you have 40 products being offered, you're tending not to go for the highest, because those things have to be done with that confidence interval, with that random thing. So when you do it as a random thing, as we have, it doesn't seem that way. But I haven't shown you the graph because the graphs are still being drawn. So the dynamic analysis may be another paper. But thanks for your comment. That's exactly what we think, because we are focusing on deposit insurance. And if it's just deposit insurance within a country, it doesn't matter.
Addressing this trend of believers reducing their choice, do you know the amount of each of their deposits? Maybe
Yeah.
they make a large deposit at first, and then after that they sort of reduce the exposure.
We haven't checked that.
And second question is, I guess we can all understand the polarization in the interest rates, but the polarization in belief, in particular, when you mention that the doubters tend to be in East Germany. But then my question is, and you say that maybe this is tied to sort of their political belief, but I'm not sure if you will, if you can show, for example, if I'm in Frankfurt, if I live in Frankfurt, I live in Bonn, München, and I'm comparing someone else in Dresden, for example, who might have, I'm not sure, I don't know, a lower income, right? Lower savings level, then maybe those guys will have.
So when we do this regressions,
Right.
we actually control for all of these. So not one, and those are not
Right.
univariate things.
Right.
So we have whether you go for the highest, and we have each of their variables, whether you're male, female, gender didn't matter. So this is a multivariate regression.
Okay, but maybe those in the West, they have higher wealth to begin
So
with.
we have control for that.
Oh, you control for that.
So this is multivariate regression.
Ah,
So we're just looking in that multivariate
That's
regression,
interesting.
which are the ones which are standing out. But yes, first question is actually interesting, which is the euro amounts invested. We haven't checked that. But now that we are focusing on, because I shouldn't have presented the last few slides, because the dynamic thing we haven't thought of. Maybe the dynamic thing is actually much simpler, because what happens is the following. If you like Bulgaria, and Bulgaria is offering you the highest interest rate, you go for the highest interest rate. In 1 year from now, Bulgaria is not offering you the highest interest rate, but you still like Bulgaria. So by definition, therefore, you're not going for the highest interest rate. And we think that's what's happening. So there's this preference for certain countries, but we have to check that. So that's why I don't want to stick my nose out on the dynamic aspects of this, though the dynamic aspects of this has to be done because it has to reinforce our story or destroy our story. So that's completely rudimentary at the moment. But the static aspects, this polarization thing, I think exists in the data. And that's the thing that, if remember, these days people ask you, what's the edge of your paper? What's the new thing that you're saying? And I think, because in econ, for those of you who are classically trained, there's something called revealed preferences. So what's revealed preferences? You ask people what your preferences are, and some people say, people will bullshit. So you see what they're actually doing. So this is revealed preference. You see what they're actually doing. And from that, we are backing out what we think are the revealed beliefs. Now, in a top journal, they'll say, okay, good, but we want you to reinforce this. So then we'll have to do surveys and things like that. So there's a lot more robustness text to be done. Plus, we have this problem that we're working with a big company who wants to be anonymous. And there are lots of things that they won't share with us.
Any questions? All the participants, you can raise your hand if you have questions.
And if you're shy, you can always email to me.
Okay, thank you, Professor Utpal, for excellent presentation about believer and doubter, and your insight about deposit and banks. Thank you very much.
Okay, thank you. You don't have a question? You don't want to chew me? Private trade. But first, I've earned my lunch, right?